And I'm still a bit behind on the recording, so I'll continue to plug away trying to get those posted up to YouTube. I'm gonna have a little trouble seeing you tonight because my control computer here decided that they decided to expire my password at 5 o'clock on a class day. Why they don't do that earlier in the day so I can handle it, I don't know, but that's a decision that are above my head. So bear with me if I'm not seeing something or you're not seeing something. You're gonna have to tell me if you're not seeing something, because I'm not able to log into my Zoom to be able to monitor the class at the same time. So okay, but let's go ahead and proceed. I think we should be okay. And what we're going to do is finish up chapter 3 tonight. And then we're also going to spend some time hopefully getting into the first couple of modules of chapter 4. As I mentioned when we did our little introduction to chapter 3, a few classes back, I guess a couple classes back, audit sampling is not a real heavy area on the exam. It's about 5 points. However, it is one of those areas that if you don't spend the requisite time with it, it could seem like an area that has a lot more difficulty for you and could slow you down on the exam and that sort of thing. So I want to spend a good chunk of time going through this notion of audit sampling. A lot of times when students see sampling, or they see the notion of audit sampling, they automatically think that they're going to have to remember everything from their statistics class. Not the case. Okay, what we're going to be doing is looking at when an auditor looks at less than 100% of a population, which is often the case. We take a sample of transactions and do our audit procedures, either control procedure or substantive procedure on those. What are some of the key words, key definitions that we have to be aware of? There might be a few calculations that you'll have to make here, but nothing sophisticated like maybe you saw in your statistics class where they had you taking a CHI analysis or something, you know, forwarding to us accountants like that. So it's really applying statistical language to the notion of doing an audit. Okay, so let's just go ahead and start to understand what happens with audit sampling and what's going on. And with audit sampling, we're looking at less than 100% of items in a population, and that could be a transactions or account balance, whatever. But we're not going to look at every single transaction, and that is often the case. Now, they tell us here that inherent in audit sampling is the concept of sampling risk. Okay, and the sampling risk is that had we been able to look at all the items in the population, we would have come up with a different conclusion than what we come up with if we are looking at the sample. Now, just to use a silly example, okay, and you know, just to sort of help us to get the feel for this a little bit, okay, sampling risk is the risk that the sample is not representative of the population. So let's just think about this for a second. Let's say I have a barrel of apples here, say 100 apples, and let's say you like apples and I offer you one. You say, okay, you start to reach into the barrel with the 100 apples. And I tell you, oh, wait, before you have one, I feel I should tell you that some of these apples might be poison. And so you say, well, okay, thanks for warning me. I said, but don't worry, what we can do is we can take a sample of the apples to see what our projection is of how many poison apples there are in here. So I go ahead and I sample 10 apples, I do some sort of procedure on them, and it comes back that the apples are, none of the 10 apples are poisonous. So then I put the 10 apples back in the barrel, mix them up, and I say, do you want an apple? What is your answer going to be?
Yes.
No.
Well, I'm thinking most people would say no, because they would instinctively feel that even though those 10 apples came back saying that there was no poison, there's a chance that there's a poison apple still in that barrel, right? Michael?
Yeah, makes sense. I was just thinking, if you take 10 of the apples and then none of those, there's a lesser chance maybe.
There is, well, yeah, we've got something more than just sort of the random, well, I don't care, let me eat the apples. They could all been poison, right? For all we knew, but we know at least 10 aren't. But we're also suffering from this notion that, well, maybe there is a poison apple in there. And I guarantee you, you wouldn't try one. You'd say no. In fact, you'd make me test every single apple in that barrel before you try one, right? Even if I tried 99 apples, okay, or tested, I should say 99 apples, I'm the kind of guy that believes that I'll be the unlucky one to grab the one poison apple out of there, right? Okay, so instinctively, that is the notion of sampling risk. There is always the chance that the sample will reflect something than what is in the true population. Okay, that's what we mean by sampling risk. Now, you're already getting a sense of some ways of mitigating that sampling risk, which is what? Take a larger sample. The larger the sample, the more opportunity that that sample is going to be representative, and we'll start to get to some of that as we go along. Okay. Now, when we are doing an audit, okay, there are both allowable in the standards for us to use statistical sampling, which is going to be our discussion today, or non-statistical sampling. Either statistical or non-statistical sampling is considered acceptable by the standards. Okay, now, why then, if we could use non-statistical sampling where the auditor could just sort of haphazardly pull different items, why then would anybody use statistical sampling? Well, non-statistical sampling is less reliable than statistical sampling. And coming over to the next page, let's go ahead and flashcard what some of the advantages are of statistical sampling, because you know that the exam loves advantage versus disadvantage. And some of the advantages are that they measure the sufficiency of the audit evidence obtained. When I use statistical sampling, I will be able to tell you how confident I am in my answer. And you're never 100% confident in your answer because there's always the chance of what? That sampling risk. But you could say I'm 99% confident, I'm 95% confident. You can also provide a precision, a range. I am 99% certain that the population, the true population, will not go outside of these parameters. And it allows the auditor to make very informed, measured decisions as to the sufficiency of audit evidence. And so it provides a basis for quantitatively evaluating the sample results. I'm 99% confident that the population does not fall outside of these parameters. Okay. Now, when you use statistical sampling, you must use random selection methods in order for that population to have a better chance of being that sample having a better chance of being representative of that population. Okay. Now, we come over and we're going to be using sampling in audit for two things. Attribute sampling is used when we are testing our internal control, okay? This is a yes or no answer. We're going to be looking at some examples here, but let's say that management tells us that the supervisor is to sign off on the employee's time cards, okay? Does that sound like a good internal control? Do you like the design of that control?
Yes.
Yeah, supervisors should have a sense as to the efforts of their employees and whatnot. Good, Donald. So I like the the design. How about implementation? What are we going to do?
Check time cards.
Well, implementation, we'll probably do a walkthrough in which we'll get there one day and we'll look to see that the supervisor is interacting with the employees and aware of their efforts and that they're clocking in. If we do a walkthrough and the supervisor is not there and the supervisor comes in with, looking like they got a hangover at noon, well, then we're not nearly as happy with the implementation of that. So we'd say, well, we like the design. We don't like the implementation. We assess the risk of material misstatement at the maximum. If we assess the risk of material misstatement at the maximum, are we going to test the operating effectiveness?
No.
No, we will bypass the testing of operating effectiveness. Good. And so we would not have to even worry about a sample. But let's say we like the design, We see that the control has been implemented, okay, when we do our walkthrough, and so we decide to test the operating effectiveness. What would we do? We'd pull 100 time cards out of, say, 10,000 time cards. We're not going to look at all 10,000 time cards that we use throughout the year. Let's say we pull a sample of 100 time cards, and we literally will look, yes or no, is the supervisor's signature there? For that kind of testing, we will use attribute sampling for our control testing. Okay. Now, at that point, we haven't audited any of the account balances or transactions, the dollar amount. So for our what? For our substantive testing, okay, then what? We will use, and we're going to talk tonight about two different sampling methods, variable sampling versus PPS sampling, probability proportionate to size. These are the two most commonly used audit sampling techniques that are used for our statistical sampling. Okay, I mean for our substantive testing, I should say. Okay, so go ahead and flashcard the types of sampling that we're going to talk about: attribute sampling, variable sampling, PPS sampling, and that one is used for internal control. The other two are used for helping us with our substantive testing. Okay, now you come over and we start to talk about uncertainties. Okay, now the uncertainty in the audit arena is what? Our audit risk. How do we define audit risk? How do we define audit risk?
Risk of material misstatement.
Okay, good. It's going to be the RMM, risk of material misstatement, times what?
Detection risk.
Good, times the detection risk. And Donald, why don't we go ahead and break that risk of material misstatement into some more elements here.
Control risk.
RMM, good, Eric, is going to be what? Our inherent risk times our
Control risk.
control risk, right? Times our detection risk. Okay, good. Now, let me ask you a question. Do we use sampling for any of this work, making these assessment of these risks? Let me ask you a different question. Can audit risk ever be zero?
No.
No. So audit risk, there will always be some audit risk, say 0.05. So can any of the elements of the audit risk equation ever be zero?
No.
No, that has more to do with math than accounting and auditing, right? No, I can't. None of the elements can be zero. So there'll always be some risk with these. So since some risks come from sampling, where do you think the sampling risk is going to hit most?
Our detection risk.
Okay, well, it's going to hit detection risk, but it's also going to hit what? Control risk, because as I just stated, with our attribute sampling, we are going to use what? We are going to use sampling for assessing our controls, right? Right? So when we look at sampling risk, uncertainties due to sampling, I think uncertainties due to sampling. Okay, why did that have to happen? I think that our uncertainties due to sampling, I have a feeling it's going to be one of those kind of nights here. Our uncertainty due to sampling, really, is the software going to really fuck with me tonight? Okay, I guess it is. 1 second, guys. Okay, so our risk due to sampling is really hitting what? Really hitting our control risk and our detection risk, right? Okay, so when we're looking at that sampling risk, we're really, you've seen it, okay? I don't know what it's doing now. So when we look, there are uncertainties due to sampling and uncertainties due to factors other than sampling, okay? So there are other factors that are going to affect our audit risk that really have nothing to do with sampling. And we're going to see what some of those are, okay, when we get up into, and you can look at C, page, and you can look at see page 75, and it's going to be item 2.3, and we don't have to turn there now, but I'm going to remind you as to what the uncertainties are due to factors other than sampling a little bit later. Okay. Now, since we can break that notion of sampling risk into how it affects what? How it affects our inherent risk and our how it affects our control risk and our detection risk. Okay. Notice that we have what? Sampling risk in substantive testing. Well, that's affecting what? DR. And sampling risk as it relates to control testing, that's going to be what? That's going to be our CR, right? Okay. Now, when we look at this, we can break our detection risk being affected by audit sampling into two further categories. One is the risk of incorrect acceptance. The other is the risk of incorrect rejection. Okay, now when we look at the risk of incorrect acceptance, okay, the risk of incorrect acceptance is the risk that the auditor will give, say, an unmodified, unqualified opinion based on the results of the substantive testing sample, when in fact the auditor should have done what? Should have qualified or adversed their opinion. This is what? This is audit failure, isn't it? We give the unmodified, unqualified opinion when we should have qualified. And the reason in this case that we've given that wrong opinion is that we use sampling and the sample was not representative of the population. Okay. Now, risk of incorrect rejection is the risk that the auditor will determine that there is a material misstatement, want to qualify the opinion when in fact, if they had looked at 100% of the transactions, they made that conclusion based on the sample. If we'd looked at 100% of the transactions, we would have found that there was not a misstatement. We incorrectly rejected the financial statements. Now, let me ask you something. Is the risk of incorrect acceptance and the risk of incorrect rejection a mistake that is made by the auditor?
Yes.
Yeah. You've drawn the wrong conclusion. You made a mistake, didn't you? That is incorrect. Okay, good. And that mistake was what? Was caused by the fact that the sample was not representative of the population. Okay. Now you come over and you look at how sampling can affect our control risk. Okay. And we have the risk of assessing control risk too low and the risk of assessing control risk too high. Let me ask you, are these mistakes that are made by the auditor?
Yes.
Yes.
Yeah, too low, too high, right? If Stephen Curry goes to shoot the ball and he shoots it too high, which he doesn't do very often, right? The ball will go over the backboard, whatever. He shoots it too low, it'll go under the net, whatever, right? But it's not an accurate shot. And the auditor makes this mistake because what? The auditor makes this mistake because the sample was not representative of the population. So in the risk of assessing control risk too low, based on the sample, the auditor determines the control has operating effectiveness. I pulled the 100 time cards. I look, they're all signed. So I think, okay, the control has operating effectiveness, when in fact, if I had looked at all 10,000 time cards, I would have found that, 8,000 of them weren't signed. Now, it's not likely in the statistical world that that would happen, but there is that risk, right? And that would be the risk of assessing control risk too low. The risk of assessing control risk too high says, well, based on the sample, you test the control, you determine the control did not have operating effectiveness, when if you had looked at the entire population, you would have realized that the control did have operating effectiveness. So maybe I pulled the time cards, I looked at 100 of them, and maybe I found 20 that weren't signed. I say that's an unacceptably too high non-compliance with the control. So I'm going to determine that the control does not have operating effectiveness. And it maybe just so happens that I was unlucky and I picked the only 20 time cards that weren't signed. And if I had looked at the entire population, I would have found that the occurrence of the control not having operating effectiveness was much lower. Okay. Question.
I got one. So I mean, we would rather have the risk of assessment control risk too high than the other way around, right? Because if we assess the control risk too high incorrectly, I mean, we end up just going into more substantive testing, and we could still theoretically get the correct opinion at the end.
Yeah, you're right on target. In fact, you're so right on target that the next thing I was going to talk to you about is going to answer that question. Okay. So what happens if we, and I'll go to effectiveness first because the way you asked your question, if we have suffered the risk of assessing control risk too low or the risk of incorrect acceptance, that is going to make our audit less effective. It's going to alter the effectiveness of our audit because, as you stated, if you assess control risk too low, right? If you assess control risk too low, what's going to happen? You're going to say, oh, the control has operating effectiveness. You'll alter the nature, extent, and timing of your substantive procedures to give you less reliable evidence. And there's an increased chance now that you're going to miss a material misstatement because you did not, have the control, the support of the controls that you thought you had because you assessed control risk too low. Risk of incorrect acceptance is audit failure. You gave the wrong opinion, right? So that's obviously not an effective audit. To your point on the efficiency, if you have suffered the risk of assessing control risk too high, or the risk of incorrect acceptance, the risk of incorrect rejection, what's going to happen here? Well, if I assess control risk too high, I'm going to do the full measure of substantive testing, but I'll still probably come to the right answer, just not in a very efficient manner, because I probably could have used less effective procedures, like using internal evidence, doing interim testing, using smaller sample sizes for my substantive testing, and I'll come to the right answer. If I have risk of incorrect rejection, what's going to happen? I'm going to sit there and say, I think there's a material misstatement in this account balance. So what am I going to do? I'm going to pull a larger sample for my substantive testing. Remember, we said that if you look and you see that there's some problems, then you'll probably do what? You'll probably expand the sample to get behind, well, what should be the adjustment and whatnot. And when you go ahead and you pull those additional sample items, then you'll discover, you know what, there actually is not a material misstatement. So you come to the right answer, but not in a very efficient manner.
At what point would it not be the auditor's fault? Because, again, it's a sample. So even if you did an excellent job, the high number of samples, you could have some misses, after a while.
Well, we give reasonable assurance. It's always the auditor's fault if you don't find something that there's a misstatement. Well, I shouldn't say it's always the auditor's fault. I mean, when I'm talking about sampling, it's kind of your fault because you were the one that pulled the sample and you made the decisions as to confidence levels in that, and you just didn't find the problem. So it's always the auditor's fault, if you will, but it's the degree of due professional care that was exercised, right? So if you took a statistically valid sample and it just so happened you had some freaky population that wasn't representative, I think you have a defense, right? And your defense would be, I gave reasonable assurance. I did what I was supposed to do in terms of sample size. I followed the standard. I did the procedures correctly. And I didn't give absolute assurance. And one of the reasons I don't give absolute assurance is I don't do 100% audit. Okay. Okay, good. Now you come over and you take a look, and let's go ahead. What I want you to do, guys, is flashcard the tables here, which are going to summarize the last couple of things that we talked about here. Okay, so when you take a look at these tables, and if you don't have flashcards like this already, what I recommend in the Becker pre-made flashcards, I suggest you copy the page out of your text and then cut it out into flashcard size because it kind of lends itself to that, okay? But the way this table works, okay, it's going to take some of the factors we talked about on the previous pages, which I didn't ask you to flashcard because I knew we could do it here, okay? So let's say, and let's go ahead and look at our substantive testing table here. First, the detection risk situation, right? Being affected by sampling. and the sample indicates that the population is okay. Okay, now this is telling you the true value, the true condition, probably a better word, of the population, and the true value of the population is okay. Now, let me ask you a question. Do auditors ever really know the true condition of a population?
No,
No, not really. If you're using sampling, no. Okay, so only God knows the true condition of the population, but the examiners could play God, right? And say, well, your sample says okay, the population really is okay. Ding, that's a correct decision. Okay. Now, if the sample says that the population is okay and it's not okay, that's what? That's the risk of incorrect acceptance. My audit is not effective, right? Okay. If the population, the sample says that the population is not okay and it's not okay, that is a correct decision. Okay. If the sample says that the population is not okay when it is okay, that's the risk of incorrect rejection. My audit is not efficient. So this table does a nice job of summarizing what we just saw above. For the tested controls, population, sample indicates the population is okay. It really is okay. That's a correct decision. Sample indicates the population is okay and it's not okay. That's the risk of assessing control risk too low. The audit is not effective. Sample indicates the population is not okay and it's not okay. That's a correct decision. Not okay when it is okay. Risk of assessing control risk too high. The audit is not efficient. Okay, now let me say something. There is a question in your homework. And I think they put a question that's like the first 5 or 6 questions in your homework set. Skip those at first because the questions, it says a partner developed a table to help you to understand sampling, right? And then they start asking you a series of questions based on that table. And it's the stupidest looking table in the world. If a partner gave a table to help understand those kinds, that was his way of teaching, he should not teach ever again. Okay, and so don't worry about those first few questions you see in the homework. When you start seeing that table, skip past those, get to the more common type of question that I think you'll see on the exam, because I don't want you freaking out right at the very beginning that you don't understand this stuff. Okay, so when you come to those questions that give you the table, don't trip on that right away. Go past those questions, work the other ones, and then come back and work those after you've got some good feelings about this topic under your belt. Okay. Okay, good. Let's come over then. And as I had indicated, not all of our audit risk is attributable to sampling. Okay, so there are some non-sampling risks, such as maybe we don't do the procedure correctly, or maybe there's what? Some sort of fraud or collusion going on that will cause us to give the incorrect opinion. Okay, so in the case of, hey, we looked at the document and we missed the misstatement. Well, that is our fault. But if it's getting to your question, Eric, if the misstatement was covered up by fraud or collusion or something like that, okay, I thought they had that there, but let's write that in. Concealment. That says concealment / fraud. I thought that was there, but I guess they didn't have it. These would be factors that are not attributable to audit sampling that are causing us to have audit risk. Okay. Okay, good. Now you come over and we take a look and we start out with an example of attribute testing. Attribute testing is used for what? Used for our internal controls. For example, a yes or no question that would be seeing our time cards signed off by the supervisor, whatever, right? So attribute sampling is used for what type of testing? For our control testing, for testing the operating effectiveness of our controls. Okay, so we use it for control testing. And we're just looking to see if the transaction contains the attribute of the control, the supervisor's signature, whatever it is, okay? Now we come in and we start talking about tolerable deviation rate, okay? And tolerable deviation rate, I want you to write the word planned right here, okay? And then kind of point to tolerable deviation rate. Now we don't call it planned, okay? We call it tolerable deviation rate, but it is the maximum rate of deviation from a prescribed control the auditor will tolerate without modifying the planned reliance on the control. In other words, it's the amount of deviation from the control that I will tolerate without believing that the control does not have operating effectiveness, is another way to look at that, okay? So let's say the auditor sets a tolerable deviation rate, and let's say the auditor sets that tolerable deviation rate at 6%. At that point in time, I'm going to look at 100 time cards, and I'm saying, as long as I see 6 or less time cards that are not signed, I'll believe that that control has operating effectiveness. Now, at that point in time, how many time cards has the supervisor really looked at? I mean, has the auditor actually looked at? It's going to be one of those lines.
None.
Good. So far, I haven't looked at any, okay? Based on my understanding of that control, I have to attain an understanding, evaluate the design, see the controls have operating effectiveness, and I want to see how it's going to affect in the timing, extent, and nature, and I pick a tolerable deviation rate, and in this example, I say 6%. Good, okay? Then what? Then I will go ahead, I'll pull the time cards, and I will look at them to see if the control had operating effectiveness. So now I'm writing next to deviation rate, I'm writing what? The word actual. Now that's not what we call it. We call it what? We call it tolerable deviation rate, and then we just call it deviation rate when we're sitting here and we're talking about the actual testing that was done. Okay, and the deviation rate in the sample is the auditor's best estimate of the deviation rate in the population. Now you say best estimate, what we mean there is best estimate what? Based on the sample, right? What do we think it is in the population based on the sample? So now I pull those 100 time cards and I find 4 that are not signed. What's my deviation rate?
4%.
4%.
4%. Good. Now, if my what? If my tolerable deviation rate, where did I write that? Oh, I didn't write it. Okay. If my tolerable deviation rate, TDR, had been 6%, is this a happy auditor or a sad auditor?
Happy.
This is the happy auditor because I said, hey, I'm willing to take 6%. I'm down here at 4%. Okay, so I'm happy. Okay. Now, if the tolerable deviation rate had been, say, 3%. Now what? And I pull the sample and I look and I find 4 time cards that aren't signed. Now what?
Less happy.
Not a happy auditor unless this auditor has a fetish for substantive testing, because what I'm going to have to do now, I'm saying the control does not have operating effectiveness. I'm going to assess the control risk higher, maybe at the maximum. Now I have to lower my detection risk. So now what? Nature, extent, timing of my substantive procedures. Nature, I'm going to have to use external evidence instead of internal evidence. And extent, pull larger sample sizes now for my substantive testing. And I'm probably going to have to do year-end testing. Good.
And that's kind of like a gray area though, too, because it's like, who's to say 3% or 6% is acceptable, when it comes down to that audit.
I am to say.
No, but
Please
how does somebody?
I have a license to say so.
But I'm saying, when you say 3 versus 6.
I have a license that allows me to say that.
So this is just based on judgment solely?
Everything is based on judgment.
So 6 and 3, it's the auditor's judgment. That's the only line.
Yeah,
Okay.
yeah, that's what
It
we're.
seems like
basically
there'd
doing.
be a standard that you would judge against, though. There's no standard that goes
No.
with like say industry or anything?
No.
All right.
You think the standard is going to come down and tell you this is the tolerable amount of deviation from a control to?
Well, just acceptable percentage levels. I guess I'm a tax person, so I guess I'm just thinking in a tax mind.
Yeah, no, this is the auditor's judgment. I mean, look, you can't be sitting here saying, well, you know, I'll accept 80% deviation from the control. And that will still, you know, assess support a lower assessed level control risk. So of course, there's, you know, what do we call it? You know, we were providing reasonable assurance, right? So if you sit there and you're not reasonable, then how can you provide reasonable assurance? So yeah, there's sort of this reasonable person, you know, tenet that's out there. But no, the standards don't come down and say, you know, when you look at this audit sampling guide, the audit sampling guide doesn't come down and say, now, tolerable deviation rate of 3 supports a low, and no, that's not how it works. The standards would never put an auditor into a position where they tell you what it is. I mean, I shouldn't say never, because on occasion, they do come out, you know, strongly. For example, no direct investment in a client is allowed because that'll impair your independence. So they don't give you any judgment on that one. Now, I'm going to be giving you some numbers that I've read about here that indicate for a certain assessment of control risk what might be a tolerable deviation rate, but this is a textbook. This is not a standard. Standards don't do that. Textbooks suggest, okay, but they are not authoritative standard. Okay.
So I think that's where we say professional judgment, that not just like random judgment of someone, right? We're professional
Yeah.
doing it. And
we-
at the end of the day, if you're just putting numbers there without, you know, without thinking through it, at the end of the day, you'll be impacted because you'll be working more if your estimate or judgment is not right. So I think professional judgment, I would say.
It's professional judgment. It's the auditor's risk aversion. How averse to you are risk? So some people might say, well, I would never set this is way too high. Other people might say no. And then it depends on the importance of the account balance. How material is the account balance? How material is the account balance as it relates to the overall presentation of the financial statements? There may be qualitative aspects that make this account balance more important. So I want to make sure that there's hardly any deviation from the prescribed control, et cetera. Okay, but it's a judgment thing. Standards don't come out and call out and tell you this is the amount of deviation that means this, because there could be a lot of different factors that go into that consideration. Okay, okay, good. Now let's come over and let's just take a look at this example down here. And this is a nice example. This example was in the Becker material back when I was a boy, back when Newt Becker was a boy. And it's a very nice example that's going to bring home a lot of these things that we're trying to, and I can't see what my camera looks like, so if my face is being washed out by the sunset here, I apologize. But anyway, let's go ahead and let's take a look, okay? So what do? When we are doing an audit, we're going to look at the controls, and we are sitting here, and the objective of the test is to determine the percentage of sales orders that are missing credit approval. So why does an auditor care if a sales invoice has credit approval? So I'm going to allow somebody to, I'm going to make a sale, and I'm going to let them do it on credit, obviously. But that sales order should have a stamp on there that says that the credit is approved, that they check the person's credit. Okay. And I'm looking for, of course, the one that doesn't have that. I'm looking for the missing sales order, but the expectation, the attribute I'm looking for is that credit approval. I'm looking for one that doesn't have it. Okay. Now, why does the auditor care?
Because sales on credit could be faked. If they don't have approval, then, that that could potentially overstate your revenue if they faked it, and then also your accounts receivable balances wouldn't be what those.
Let's say, Donald, God comes down and tells you there's really a person there. It's not a fake sale. A person really got the goods. They were shipped to them. They got the goods. They're enjoying the goods.
They might not pay you though.
Oh, okay. So you're telling me that it's not that the sale didn't happen, it's that the person may not be able to pay me? Is that what
Yeah,
you're saying?
if they didn't get approved, I mean, that's probably.
Okay, so if that's the case, what assertion are we talking about?
Valuation.
Excellent. Okay, the auditor does this. Excellent work, because they are concerned about what? About the valuation assertion. So just to go back, and I forgot to open this before class, but I should be able to find it here fairly easily, I would think. Then again, maybe not. It looks like nothing's going to be easy tonight. Oh, I know where it was. That's why I'm having trouble finding it. Okay, here it is. Okay, so I'm going to put this thing back up, which you guys are probably tired of seeing it. That's okay. Right? What do? We sit there. Can you see that little matrix thing that I put up, the sales matrix?
Yes.
Yeah, okay. So what do? When we look at the potential misstatement, okay, the potential misstatement, then we look at the control and we assess the control risk, and then we determine the timing, extent, and nature of our further audit procedures. So when we're looking at the controls, guys, I want you to stop thinking about it as, oh boy, controls. I love to look at signatures. I love to look at credit approval. Why are you doing this? You are doing this because you think this control will help prevent or detect a misstatement in what assertion? And Donald, very good. We're talking about what? We're talking about the valuation assertion here, right? Okay. Okay, good. Now you come over and we're worried about that. Now, sometimes I'll get students that'll say, well, also, we want to make sure that, we're going to get paid at some point in time. Well, that would be more the credit of what? Of the client that we're concerned about. And that really doesn't affect our audit risk. That affects what? Our business risk, right? Okay. Okay, good. Now you come over and we determine the population. Okay. And the population would be all the sales orders that were used during the year. And if a sales order comes up in our sample, okay, then we have to oh, sorry guys. I'm jumping what I wanted to say here. I'll come back to that point in a second. Rewind, come back. It's all sales orders that had occurred during the year. And if we perform the test at an interim date, if you perform the test at an interim date, you still have to do what? You still have to do a roll forward. For example, we might take a smaller sample of transactions towards the back end, maybe that last quarter, just to see if the controls have still been having the operating effectiveness at the back end of the year. So even though you do interim testing, and that's where you do the bulk of your testing, you'd still want to do some sort of roll forward testing. We're just reminding you of that. So flashcard that point. Okay. Now, each sales order is a sampling unit. And this is something that over the years, I had to always remind folks of the importance of this other part down here, which is you have to make sure that from whatever you're pulling your sample from, that it matches to what you reconciles to what you're ultimately auditing. So if you're sitting there and you're auditing a GL balance, but you're going to pull your sample from the subsidiary ledgers, the subsidiary ledger of, say, accounts receivable or something, where you're going to pull the sample, make sure that what's showing in the subsidiary ledger for the account receivable, where you're going to pull your sample, matches to what they're saying the recorded balance is. Otherwise, it's what, garbage in, garbage out. You're not taking a sample from a representative group of transactions. Okay. Now, and so that should happen before you pull the sample. And I've had folks tell me, well, we're going to do that part after. I'm like, no, you're not. You're going to do that now before we pull the sample. I don't want to get out there and then later on we find out that we pulled the sample from something that wasn't representative of the population or wasn't at least reconciling to the population. Okay. Now we are looking for what? Missing a credit approval. Missing credit approval. Okay. Now, if there is a missing sales order that comes up in our population, we want to examine that for credit approval. And when we ask for it, they ain't got it, then that is considered a deviation from the control. They can't tell you, oh, no, I'm pretty sure that one had the credit approval. No, that is considered a deviation. Okay. Okay, good. Now, determine the sample size. Okay, what we're going to look at, and I'm going to ask you to flashcard these, is how these different factors affect, I should say, the sample size for our control test here. Okay, so risk of assessing control risk too low. And they tell us here that what? There is an inverse relationship to sample size. Is the auditor is willing to accept greater risk, smaller sample size, less risk, larger sample size. Now, when we talk about risk of assessing control risk too low, we are talking about what? Our control risk, okay? And let's say we want our control risk to be 0.05. That means we are willing to accept what? A 5% chance that the control will not prevent or detect the misstatement. That means that when we draw our conclusions, we will be what? 95% confident. Okay, so if you're willing to accept more risk, smaller sample size, you want lower risk, larger sample size. Let's just go back to that apple thing for a second. Okay, so Michael, we had tested 10 apples and you said no, right? You don't want to eat an apple. By the way, it's not the Sleeping Beauty poison. It's the poison from that movie, The Rock, where you kind of foam up and you break your back and all that kind of stuff. So it's not a pleasant experience, okay? And so we tested 10 and you said no, right? So I said, okay, come on, we'll test 20. And they all come back and you say what? They all come back okay.
Well, I guess you would still say no then.
We're going to continue to say no because you're instinctively feeling, and again, if it's me, hey, dude, test every single apple in there. In fact, you know what? I don't want no apples because I don't want to, suffer that consequence, right? So for something like that, no sample size is big enough. Auditors don't have that luxury, right? We're going to have to deal with some sampling risk, but if we want to keep that risk of assessing control risk, and notice, Donald, your point that we're focusing on that risk of assessing control risk too low because we're trying to limit the chance that our audit is not going to be effective. So your instinct was well taken here, and that's how we look at it. We don't worry as much about the risk of assessing control risk too high. Okay, so that's going to affect our sample size in an inverse manner. The lower you want that risk, more items you have to look at. Okay, tolerable deviation rate. Intolerable deviation rate is also an inverse relationship. Okay, so if we want more risk, smaller sample size, less risk, not less risk, but less deviation rate, smaller samples, larger sample size, more deviation rate, smaller sample size, inverse relationship. Now, to the point that we were making earlier, okay, in the questions you guys asked very well earlier, let's go ahead and let's look at this a little bit more. Okay, and the suggestions that I'm going to be giving here do not come from standard. Don't walk in somewhere tomorrow and say, this is the deviation rate and associated tolerable deviation rate associated with a certain assessment of control risk. Okay, but I did see something in here along the lines of what I'm going to put up. Okay, so from a textbook standpoint, okay, if my control risk is high. Some people would suggest that my tolerable deviation rate is not applicable. Who cares? Who cares how often a control that I've assessed the control risk is high, either because I don't like the design or I've determined it hasn't been implemented? Who cares, what the tolerable deviation rate is? I don't care. Don't even apply that control anymore. You're wasting time. Okay. So what happens here? What is my sample size if I assess control risk at high for my control testing?
It'd be low or non-existent in this case.
0. I wouldn't test the controls if I assess the control risk at high. Okay. Now, if I sit here, and I'm just trying to figure out if I give myself enough columns here, and I assess the rows. If I assess the control risk at low, some literature, not standard, some literature would suggest that an auditor should consider that a low control risk means that your tolerable deviation rate is going to be between 0 and 3%. That's 3%. Now think about that for a second. What they're saying to us here, for some reason I can't make a percentage sign now, 0 to 3%. What they're saying to us here is, look, you're sitting there and you're saying you've got a low control risk. That means that you think that control is pretty good, don't you? Well, if they've got a good control, don't you want to make sure that that control is being applied? You're going to really rely on that control. So what's going to happen? We would expect a larger sample size because you're really going to want to, I don't have to write sample size again. We're going to expect a larger sample size because you're going to really want to take a good look at that control to see that it has the operating effectiveness, because you're going to rely on it because you think it's pretty good. Okay. Now, if you had assessed the control risk, say at medium, well, now you're saying, okay, it's an okay control, but it's not quite, the best I've ever seen. Well, some literature, not standard, not the CPA exam, some literature would suggest that a tolerable deviation rate between 4% and maybe 7%. Okay. And so if that's the case, then we can have a smaller sample size here, because we're not going to rely as much on a control where we have assessed the control risk maybe at medium, moderate, whatever. Is that an inverse relationship? The lower the tolerable deviation rate, the larger the sample size, right? Okay. Now, expected deviation rate, they tell us there is a direct relationship. What happens? Let's say I have a client and every year when I audit them, they screw up the controls. One day I walk in and they say, hey, auditor, we figured it out. We've got a good set of employees now, and they're doing a really nice job applying that control. I look at the design. This time I see that they've implemented it. So I decide to go ahead and do some control testing. Do you think you're going to want to get a pretty good sample size there because your past experience has caused you to expect that they screw up the control? So you're going to say, okay, it looks like you're doing a little better job, but I'm going to pull a nice big sample to make sure that that's the case, right? Because your expectation is still high. Now, let's say in the second year, you come back and they don't even make a big deal out of it, right? What are you going to do? You might in that second year still pull the same size sample just to see for sure. Maybe by the third year now you're looking and you're saying, okay, I think they get it. My expectation is that where I'm going to have a lower deviation rate, so I'm not going to pull as large a sample. Inverse relationship. The more you expect, the bigger the sample, the less you expect, the smaller sample. Did I say inverse? Direct relationship. Okay. Okay, and then population for our larger samples really does not affect, for our larger populations, I should say, doesn't really affect sample size. So when you look at some of these tables, that are contained in the, and this is not the standard, but this is the audit guide. They have tables that are for larger populations, and they have some that are for smaller populations. For a larger population, include on your flashcard, the population really does not affect sample size. Okay, okay, good. So go ahead and flashcard. It's what? Inverse, inverse, direct, no effect. Okay, okay, good. Now, let's come over and let's look at this example and see how those elements that we just looked at, other than population, on the previous page will affect sample size. Okay, so they tell us that the auditor is willing to accept a 5% risk of assessing control risk too low. 5% risk of assessing control risk too low. What confidence level is that?
95.
Good. That's the 95% confidence level. And guys, I'm asking you to make sure you're comfortable with that, you know, yin and yang, if you will, inverse relationship there. 1 minus 5%. If I'm 5% thinking there's a risk that I'll make a mistake, then I'm going to be 95% confident in my conclusion here. On the exam, they might call it the 95% risk of assessing control risk, 95% confidence level, I should say. And I don't want you to get confused and say, well, where's the 5% risk? They might call it 95% confidence level or something. Okay. Now here they come up and they tell me that the expected deviation rate is 1%. The tolerable deviation rate is 6%. Again, population is not relevant here. Okay. So I come over and I find the intersection of my, and guys, I don't recommend you mark up your table in your book as I'm going through it, because it'll allow you to kind of practice with this example later. If it's not marked up. Okay. But if you have a 5% risk, then we're on the right table. 6% tolerable deviation rate, and they said what? 1 expected deviation. So when I find the intersection to answer the question down here, my sample size is going to be what? 78. Question? Okay, then question 2 says, would the sample size increase or decrease if the expected deviation rate went to 0%? Don't look at the table, look at me. If it went to 0%, what do you think? Expected deviation rate has gone down. What's going to happen to sample size?
Goes down.
It's going to go down. It's a direct relationship, right? Because I've had lots of previous experience with this client, and I think they're doing a good job, right? So I don't have to look at as many items. Good. Okay, then number 3, what happens here? Okay, number 3 says, would the sample size increase or decrease if the tolerable deviation rate increased? So I'm willing to accept more deviation from this control. What's going to happen to the sample size?
Decrease.
The sample size good is going to decrease. In fact, it's going to decrease, and you can go ahead and write in the numbers down here. The sample size will decrease for question 2 in our little thing. It would decrease to 49. And in the situation with a tolerable rate increase, it would decrease to what? 66. Okay. And then question number 4 here says, would the sample size increase or decrease if the risk of assessing control risk too low increase to 10%? Can I answer that by looking at this table? Can I answer that by looking at this table? No, this is what? This is the 5% table. I'd have to go to what? Another table, but what I can promise you is all the numbers on that table are smaller, because what? I'm willing to take on more risk, smaller sample size. So all the numbers on that table would be smaller. So the answer here is it would do what? It would decrease, but I'd have to be on a different table. Question. Okay, so I have my sample size. I pull my sample, and now I'm going to look to see if what? It has the credit approval, right? I'm going to actually conduct my control testing now. So that's what happens. Oh, we select the sample, which is what I was just saying, but most common technique is random selection. Block sampling is not acceptable. Flashcard that. Block sampling is not acceptable, okay, for a financial statement audit. Here, the standard is telling you, don't do it, okay? Block sampling is something that you might use if you're trying to figure out a demographic of a population. Thus, the idea in block sampling, frankly, comes from the notion of census sampling, and you're trying to determine a demographic of a particular area. Then, yeah, then block sampling makes sense because you're trying to speak to the characteristics of the attributes of a certain zip code or something. Well, then you might want to use block sampling, not for an audit. Okay. Okay, good. Now you come over and you take a look, and we are going to evaluate the sample results. Okay. And we're going to go to table 2, they say, which follows on the next page. And we will go ahead and calculate the sample deviation rate. And then we will use table 2 to determine something called the upper deviation rate, which is based on the deviation rate in the sample plus an allowance for sampling risk. Okay. Now, some advice here. Use the 5% table if you pull the sample from the 5% table. The sample size, I should say, from the 5% table. When you evaluate, you need to find another 5% table, table 2, 5% table. Don't get stuck on the exam where you pull the sample and they say it was the 95%, and you're supposed to evaluate the sample, and the examiners will give you a 10% table and a 5% table. You need to go to the 5% table, right? Okay. Then you will go, and using the table, you'll find the intersection between the sample size and the number of deviations you found. That is considered your upper deviation rate. The upper deviation rate is the maximum rate of deviation that the auditor is believing is in that sample, and it is the deviation rate that you actually found in the sample plus an allowance for sampling risk. Okay, now let's think about this for a second. We're coming up on election day. We keep hearing all these projections, and during the presidential election and whatnot, you heard, okay, Trump is ahead, Biden's ahead, whatever. And they sit there, and when they give you those statistics, they always sit there and they say plus or minus 3%, whatever it is. Well, that's giving you a precision, a range around where it could be higher than lower than what they're telling you. As auditors, we don't care if it's lower. If it's lower, fine. We're worried that what? We assess control risk too low. We're worried that it might be higher. So we just worry about the upper end of that precision. Okay, and that's what this thing is allowing us to do. Now, I'm going to go ahead and ask you to flashcard this formula, whatever you want to call it, equation, but I will come back and I will kind of walk you through this after we look at the example. So I'll come back to that, but let's just take a look. And we say calculate the deviation rate if we have a sample size of 100 and we find one deviation. Now, guys, they threw away the 78. So they're saying, forget the 78. Now pretend that our sample is what? 100. Okay. So we have 100 items that we look for the sales approval on. What that nonsense was about. What this is all about here. Let's not start with me. Okay. One second, guys. One second. So no, I don't want that software. One second. Well, 1 second. I think I'm going to tell it to discard, so maybe it'll forget whatever it was trying to do to me. Okay. I think we're going to be okay now. What page are we on? Evaluate this.
80.
80, okay. Okay, good. So just coming back here, I think we should be okay now. So they went ahead, okay, and they forgot about the 78 that we had said. They said, well, you looked at the sales orders, you looked at 100, you found one. So the deviation rate is not a trick question, is 1%, right? Okay. Now I look and I find the sample size, which again, they threw away the notion of 78 here, it's 100. And I found one deviation. I wouldn't mark up the table, okay? And so that tells me that the upper deviation rate is what? You can go ahead and write in the answer is 4.7%. Now that's telling you, hey, auditor, that's how high it can go. You're saying, but I looked and I only found one. Why are you saying that the deviation rate is 4.7%? Well, they have done what? They have put in an allowance for sampling risk. You're still looking at a sample. This is not the population. And so if you take 4.7% minus 1%, you have given yourself a cushion. You have given yourself an allowance for sampling risk of what? 3.7%. So the auditor is what percent sure that the true deviation rate does not exceed what percent? How sure are you?
96.3% sure that the risk is not above.
Where are you getting 96.3? 100 minus 3.7?
Yes.
Okay, no, I'm at what level? I'm 95% confident that the true deviation rate does not exceed what?
4.7.
7%. I've given myself a cushion of 3.7, but my confidence level is 95%. Now, if I had pulled all the sample sizes and whatnot from the 1% risk of assessing control risk too low, then I'd be what? 99% confident. If I had pulled my sample and evaluated it at the 10% table, then I'd be what? 90% sure. Okay. Okay, good. Now, as I had said, I wanted you to flashcard, although we lost our indicator here, but that's okay. We'll just write it back in. I wanted you to flashcard this, and the sample deviation rate in our little example was what? 1%, plus the allowance for sampling risk was what? 3.7% equals the upper deviation rate of 4.7%. Right? Or another way to look at it, and you can put that on the flashcard, on a flashcard as well, is that the upper deviation rate, which I'm abbreviating now UDR, minus what? Now I put those underlines there. I'm gonna write that down a little lower. The upper deviation rate minus what? Minus the sample deviation rate equals what? The allowance for sampling risk is another way to look at that. Upper deviation rate was what? 4.7%. I'll write that in a different color. The red on the page there. 4.7% upper deviation rate minus what? The sample deviation rate was 1%, gave me the allowance for sampling risk of 3.7%. Okay, question. Okay, good. Now you come over and take a look, and you now form a conclusion about the control that was tested. And they tell us if the upper deviation rate is less than or equal to the tolerable deviation rate, the auditor would rely on that control. In other words, we would determine that what? The control has operating effectiveness, and then we would go ahead, nature, extended timing, nature, less effective procedure rate using internal evidence for my substantive testing, extent, smaller sample sizes for my substantive testing. I can maybe afford to do some interim testing, right? For my substantive testing. If the upper deviation rate exceeds the auditor's tolerable rate, I might look for some other control that will tend to compensate for the control that just failed the test, or more likely, I will probably what? Modify the timing and standard nature of my substantive test. I'm going to do what? I'm going to use external evidence nature instead of internal, extend larger sample sizes now for my substantive testing, and I'll probably want to do year-end testing instead of interim. Okay. Go ahead and flashcard that. And then let's go ahead and let's take a look at the next page example. And I want you to actually flashcard this example. So you practice with this while you're looking at your flashcards. Okay. So assume the upper deviation rate, as we saw from the example, is 4.7%. Now, if the tolerable deviation rate was 3%, the auditor would rely on the control. The auditor would be happy, right? Because I was willing to accept. Oh, the answer is no. I mean, sorry. The answer here is not happy, but sad. Okay, if my tolerable deviation rate was 3% and it said 4.7%, this is what? This is the upset auditor. This is the sad auditor, because they're sitting there saying, no, I was only willing to accept 3, and this table's telling me it could be as high as 4.7%. If what? The tolerable deviation rate was 6%, now we've got the happy auditor, because the happy auditor saying, okay, I was willing to take up to 6. This thing's saying it's 4.7%. I'm good. Question. Okay, good. Now, of course, we always have to document our procedures. Okay. All right. Any question there on any of that? Okay, good. Now you come over and there's another sampling plan that leverages off of attribute sampling. It's called discovery sampling. And discovery sampling is used when the auditor believes that the condition is 0 or near 0. It is used when the auditor is looking for very critical characteristics such as fraud. Okay, so they're asking you to look for something that really shouldn't be there. Okay, they call that discovery sampling. Okay, now what the auditor will do is they'll go ahead and they'll figure out what their confidence level is and what is the tolerable rate of the condition. Okay, and then the auditor goes through And let's say in this example, the auditor set their confidence level of 95% and said, okay, the tolerable deviation occurrence of the situation is 1%. If no deviations are found, notice here, guys, the auditor doesn't say, oh, there's no deviations. The auditor then can say, hey, I'm 95% sure that the deviation rate does not exceed 1%. Whoever's engaged us to do that, can you live with this? Okay. Now, if I find more deviations, okay, then I'm probably going to say, well, look, this is falling outside of what we would really expect. We're going to have to pull a larger sample now to give you an extent as to the pervasiveness of this problem, because we really should never find the problem. Okay. But notice, guys, how in flashcard when we use discovery sampling, okay? But notice how scientific and careful the auditor is. You never walk in and give an absolute assurance that it never happened. It would never happen. Always what? Reasonable assurance. I am 95% confident that it's having more than 1%. Whatever that means to you, you live with that. I'm just telling you that it does not appear that it's a very high rate of occurrence of that particular situation, the fraud or whatever it is you're looking for.
I'm curious, briefly, do you know if the IRS does this, like their auditors? Do they actually look at things this way, or they have a whole different approach?
I would imagine that in a sample, in an audit, they use sampling. I don't know, because I've never, been on well, I went with an IRS agent on an audit one time, but we weren't getting into any kind of sampling there. The GAO Congress asked us to follow the IRS auditors on an audit. The thing that was funny there is we went back after the audit had been done. So it was the second visit that the taxpayer was getting from the IRS. And the taxpayer says, why am I being audited again? I know people that don't even pay their taxes and they don't get audited. And of course, the IRS auditor lit up and said, would you like to give us the names of those people? And he said, well, no, but anyway, that was the most entertaining part of that assignment. But I would imagine, Eric, that they are going to use some sort of sampling techniques, but they also would probably use some sort of analytical procedure. For example, if I'm a hamburger restaurant and I tell you that my revenue is X, well, there should be certain pounds of meat that go along with that. Okay, so they probably use some analytics, but they might sample some transactions looking for indicators of an understatement of the tax, I would imagine. Okay, good. They don't tell you, exactly how they do their audits, but taking a look at stop or go sampling. Stop or go sampling is something that is going to be used, they say, to avoid oversampling, and allows the auditor to stop testing before they've gone through the entire sample. So the idea here is if I pull a sample of 100 items, I'll pull my sample in such a way that if I find a deviation, I stop and I say, that's it. The control does not have operating effectiveness, and I don't have to look through all 100 items to make that determination. The tragedy there, the sad thing there would be what you've set that sample up that way, and then you look at 99 items, and then the last one has the deviation. You're like, great, so I ended up doing the whole procedure anyway. But you can pull your sample in a manner so that as soon as you find, say, a deviation, you just stop and you say, okay, the control does not have operating effectiveness. I'm just going to go further. I'm just going to go with the full amount of substantive testing. Okay, good. So with all that, before we go to the break, let's go ahead and let's take a look at some multiple choice questions tonight. Assuming I can find my, for some reason here, my, okay, it's up here now. That's okay, I guess. Okay, guys, looks like we're a little under 2 minutes here, but most of us had a chance to look at this, and the results are pretty good. We got a nearly 95% outcome. Almost everybody got this one correct. Okay, so let's just go ahead though, and let's take a look at this. And which of the following would you use attribute sampling? Well, you're going to use attribute sampling for what? For a control test. Did I stop sharing? This is the kind of thing I can't see. Is the poll out of the way now?
Yeah. it's
Yes.
Yeah, okay. So attribute sampling is doing what? To see if the control is working. Does the transaction have the attribute? For example, what? The supervisor signature, okay? These others are getting more to what? The account balance, which is what we're going to be looking at in our next module, that we would be using what? We would be using variables testing or probability proportionate to size, abbreviated PPS sampling. Okay. Okay, good. Let's go ahead then and let's put the poll back up. For our next question. Okay, guys, we're about coming up on 2 minutes, so please make your selection, okay? And good, pretty good results. A couple of us didn't get it right, but good results for what is really a fairly tough question. So that's good. That means we're getting some good understanding of some, material that is not a real high point value, but if you're not studying it, it could, kind of slow you down a bit. But let's look at this one. And we say as a result of tested controls, an auditor assessed control risk too low. So the auditor did what? The auditor made a mistake, right? Okay. Now, just to go back to our apple analogy, okay, let's say we're sitting here and we have this barrel of apples. And let's say we have 1, 2, 3, 4, 5 apples sitting in the barrel. Okay, now here comes the auditor. Okay, and the auditor does what? The auditor tests 4 of the apples, and it comes back green. Hey, no poison in those, right? So then what happens? The auditor then reaches in the barrel, grabs out the 5th apple, eats it, and what? Dies. Okay, drops the apple, the whole works, okay? This happened because what? Because the true deviation rate, okay? And I'm looking at this question right here, okay? As a result of a test of controls, the auditor assessed control risk too low. This auditor sat here and they assessed what? Control risk at what? 0 out of the 4. They said, hey, it's 0%, right? Okay. And decreased substantive testing. This assessment and they occurred because, and they say assess control risk too low, meaning they made the mistake, just like eating a poison apple is a mistake. And this happened because what? Because the true deviation rate in the population was what? More than the deviation rate in the sample. Question. Deviation rate in the sample is what? 20, and the population said was 20%, and the sample was 0%. Okay, good. Let's take a look at question 3. Okay, looks like everyone's had a chance to try this one. We did pretty good. I've got a few folks for some reason choosing D. So let's go ahead and let's look at that. Okay. And so while performing test of details during an audit, the auditor determined the sample results supported the conclusion the account balance was materially misstated. If an account balance is materially misstated, are you going to accept that balance?
No,
You would reject it, wouldn't you? So based on the sample determined it was materially misstated, you're saying, hey, I'm gonna have to qualify my opinion. I reject that, right? Then it says it in fact was not materially misstated, meaning what? It was okay. So you did what? You incorrectly rejected it, didn't you? Folks that picked D, did you read it a different way? Okay, let's go ahead and let's take a look at number 4. Okay, looks like everyone's had a chance to try this one. You're at about a minute and a half on that, which is great. Okay. And it's also great that just about everybody got this one right. Okay. So what happens? The choice here is D, but let's just take a look at this one. Okay. And they say an auditor uses statistical sampling for attribute testing, test controls, should reduce the planned reliance on the prescribed control. Now, before we look at the choices, when would you decide not to rely on a control? Just purely from a theoretical standpoint, from a language standpoint, you would do that if what? If the upper deviation rate, right, was greater than the tolerable rate, right? In other words, if the upper deviation rate was 4.7% and the tolerable deviation rate was what? Was 3%, this is the SAT auditor, you wouldn't rely on that control, right? Which is what the question was describing, okay? Now, unfortunately, they don't give us the comparison of the upper deviation rate to the tolerable rate. They tell us that what? The sample rate of deviation, say maybe 1%, plus the allowance for sampling risk, say 3.7%, right? 1% is the upper deviation rate. Does this sound familiar? This is just like we had in our little example, 1.3.7 gives you an upper deviation rate that exceeds the tolerable rate. You can't rely on the control, right? Now, I think maybe one or two people picked C, and I never quite understand why folks like C, because when I read C, I see a tolerable deviation rate of 3%, less the allowance for sampling risk of 3.7%, let's say, which would create a negative 0.7%, exceeds the sample rate of deviation. You see how twisted C is? I can't even really fully explain what C is trying to say other than jumble a bunch of words together that sound like they make sense. Okay. Question. Okay, good work, guys. That's a lot so far. We still have to get into module 9, in which we're going to start looking at our sampling plans for our substantive testing. We'll start with variables, and then we'll get into probability proportionate to size. So we'll go ahead and we'll take a 10-minute break. Starts getting us into a situation of coming back at a weird time. I'll just say 6:55, just so we don't have to, sit here and measure inches on a watch here to get us back at 6:53, whatever. I'll give you an extra 2 minutes and we'll come back at 6:55, 5 to 7. Okay. All right, guys, we'll see you in a couple minutes. I'm going to pause the recording. I'll start it back up when we come back. And we're going to jump into module 9, which is going to continue our discussion of audit sampling now, but we are going to turn our attention first to variable sampling and then PPS sampling that we will apply to our substantive tests. So we've seen how we're using sampling for our control test, our attribute sampling. Now we're going to see how we'll use sampling for our substantive tests, first variables, and then we'll talk about probability proportionate to size. Now, our planning considerations, and you're going to notice here that we have some similar terms to what we were looking at for our control testing, but now we are relating it to what? Our tolerable misstatement. And this is the maximum amount of misstatement that the auditor will accept in account balance without determining that it is materially misstated and thus feeling that the need to alter our opinions on our financial statements. Okay. Now it goes back to our discussion in chapter 2. Remember, we said that we have our materiality and we have it at the overall financial statement level. We have our materiality for a performance level, which is always less than the overall financial statement level. And then we said that when we're talking about using sampling techniques, we call that tolerable misstatement. So now we're getting in to that discussion. Okay. Now, when we come over, we want to understand this concept of stratification. Okay. Flashcard, that stratification is often used when you have a wide variability of the recorded balances of transactions in a particular account balance. Okay. For example, let's say I'm looking at accounts receivable. And when I look at the accounts receivable, they have, Adams in here. And Adams is sitting here. I'm not going to write a name for every single of these. So let's just say account receivable number 1. Okay, let's say is 100,000. Account receivable number 2 is say 100,000. Account receivable number 3 is 50,000. Account receivable 4 is 50,000, and account receivable 5, let's say, is 50,000. Okay. Then let's say account receivable 6 through 100, and let's say they have an average balance of, I don't know, I'm just going to make a number up here, 6,000 is the average balance, and they're pretty tightly grouped together. Okay. What the auditor might do, and let's say we have a total of 100 accounts receivable, 6 through 100. Oops. I'm going to do it here. 6 through 100 is an average of, whatever it is, doesn't really matter. 6 through 100, but they have a total of 100 account receivables. So what the auditor would probably do in that situation is go ahead and send out a confirmation, okay, for these 5. You just carve those off the top, because what's happening? Let's say the total recorded account balance is, and I'm again just making this number up. Let's say it's, I don't know what's a reasonable number here based on how I've set myself up, but let's say the balance is 700,000. That's the total balance. Okay. What the auditor, let's say it's a million, whatever. Okay, what the auditor would do is pick off those 5, and we've got what, 1, 2, 3, we got 350,000. Am I doing my math right? If I pick off those 5. Somebody?
Yeah.
Okay, 350,000. Thank you, Michael. Out of a million, I'm going to audit what? 35% of the account balance just by picking up those 5 accounts. Meanwhile, in terms of the number of items in the population, I'm only looking at a 5 out of 100. So I get a nice little efficiency there by carving those ones off the top. I get to look at 35% of the dollar balance while only looking at 5% of the actual items in the population. That's called stratification. Now, that doesn't mean that I'm going to ignore 6 through 100. Then I might go ahead and do what? Pull some sort of, variable sampling technique to sample the remaining, out of that remaining, whatever it is, 95 at that point. Okay. Okay, good. Now you come over and we have the concept of tolerable misstatement. Okay. But that is going to be contrasted with, and you can come down, tolerable misstatement, keep drawing your arrow down. And that is going to be contrasted here with projected misstatement. Projected misstatement is when the auditor goes ahead and applies the auditing procedure and projects a misstatement to the population based on the sample. And again, we're going to see that there's going to be some precision that we'll put around that. We'll put a range, and if we believe the misstatement is outside of a particular range, then we'll go ahead and ask for adjustment. If it's below that range, we'll accept that population. We'll determine there is not a material misstatement, okay? Now, when we project the misstatement, okay, when we project the misstatement that we will then compare to our tolerable misstatement to see if we believe there is a material misstatement, we can use different variable sampling plans here that we're going to study, and we're going to look at 3. We're going to look at mean per unit estimation. We're going to look at ratio estimation. We're going to look at difference estimation. These are variable sampling plans that you can use to project the misstatement, so you can compare that to your tolerable misstatement. Okay, now mean per unit, they tell us, uses the average value of items in the sample to estimate the true population values. So the estimate is the average sample value times the number of items in the population. Now, mean per unit, what I want you to flashcard, we don't care what the book value is of those transactions. Look at that calculation. We're simply doing what? To come up with our point estimate, okay? Because that's what we're striving for with these methods, is to come with a point estimate that will then compare to what actual recorded balance is, and then we'll determine if we think we have a material misstatement. From that, these point estimates for mean per unit, you don't need the book value to come up with a point estimate. Okay, now that is different than what we do with ratio estimation. Okay, with ratio estimation, we use that when the book value is pretty close to the audited values. Okay, so if that's the case, then what? Then our audited amounts are approximately proportionate to the client's book amounts. Now, and you can flashcard that. The auditor determines that the audited value is the correct value. And if we're pretty close, then we can, in order to come up with this point estimate, we will use ratio estimation. Difference estimation is used when the audited to book values are not nearly proportionate. Okay, so if you look back at these 3 methods, and we're going to actually come up with a dollar actual numeric example here in a couple of minutes. But when you look at these 3 methods, it's all about book value, isn't it? Okay, with mean per unit, we didn't need the book values for our point estimate. Ratio, we used it when they were pretty close. And then difference estimation if we thought the audited value to the book values were not proportionate. Okay, now you come over and we want to determine the sample size. Okay, and we're going to look at how different parameters will affect sample size. Okay, and let's just look at how they will affect increase, decrease sample size. Okay, and sample size will increase as the following increase. And so that's a direct relationship. And I want you to flashcard this. Okay, expected misstatement. Expected misstatement increases, sample size increases. What do you think? If I expect a lot of misstatement, do you think I'm going to have to really look at a lot of items to figure out what that misstatement is?
Yes.
Yeah, I got a sloppy accounting going on here that I got to really work hard to find what that misstatement is. The variability in the population, okay? If I have a lot of variability in the population, that's the case in any population. It's not just for accounting, not just for auditing financial statements. Anytime you have a population with a lot of variability, you're going to need a larger sample size to get a handle on that variability to be able to make your decisions about your confidence levels and your precision and all that kind of stuff. Okay. Assessed level of risk. What risk? They say assessed level of risk. What risk?
Risk of material misstatement.
Beautiful. I mean, we need to start to get into that. We say things in here, little risk, and they're kind of a little sloppy there. We need to understand the risk that we're assessing, that we're all about in this thing is the RMM. Okay, good. So if the RMM is up, what are we saying is up here? What are the elements of RMM?
Inherent risk and control risk.
Good. Inherent risk and control risk. are up. So what do we want to be down?
Detection risk,
We want detection risk down. So what's got to be up?
substantive testing,
Substantive testing, timing, extent, nature, and now, Michael, and good work. Okay, we are sitting there and we're saying what? Nature, and now we're finally putting a star on what? Extent. We're gonna have a larger sample size.
yeah,
Okay, good. Sample size will decrease if my what? If my tolerable misstatement goes up. If I'm sitting there and I'm inverse relationship here, if I'm sitting here and I'm saying, hey, you know what? $10 billion of misstatement would not make a difference to the user of the financial statements. Well, I don't have to sit there and find a sample to find a $10 billion error, right? It's going to step up and say, here I am. Okay, so as my tolerable misstatement goes up, my sample size can come down. If I say, hey, 2-cent error, well, geez, I probably won't even be able to do that audit because now I'm going to have to audit so much that I could never get a satisfactory coverage there. Of course, I'm exaggerating that. Acceptable level of risk, what now? If our RMM is down, then our detection risk can be what? Again, that's IR times CR, just to be consistent. Our detection risk can be up. That means our substantive testing can be down. And now we're talking what? Nature, and we're finally focusing on extent, smaller sample size, right? Okay. Okay, good. So make sure you flashcard how these elements affect sample size. The exam will ask you questions on that, I promise you. Okay. Now you come over and we're going to pull the sample and we're going to evaluate the sample results, and we're going to apply an allowance for sampling risk, a precision to the point estimate, and that's how we'll determine whether or not we think there is a material misstatement. Okay. Now, what this is showing you is the 3 methods that we have already sort of flashcarded how we would use book value in these estimation techniques under variable sampling: mean per unit, ratio estimation, difference estimation. Okay. Now, we're going to come up with the point estimate. That really is the outcome of this exercise. Now, you come over and they tell us that the population is 5,000. Okay, and the book value is 4,500,000. The auditor selects 200 accounts with a book value of 184,200. The audited value based on the confirmations is what is going to be 175,000 with an average value of 875. Okay, so we took the 175,000, the total of our audited values. We sent out the confirmation. They came back different from what the client was saying, right? Okay, and we divided that by the number of accounts that we looked at, and we came up with the average value. Now, we have this average value, which we came up with by using the audited values, times the number of accounts in the population, and we have our point estimate. Thus, our flashcard about mean per unit, we didn't look at the book values to come up with the point estimate. We looked at the audited values. We divided that by what? By the number of items in the sample. That gave us the average sample value. We multiplied by the number of counts in the population. We maybe didn't even look at the book values that were recorded for those particular items. Okay. Okay, good. Now, with ratio estimation, what we'll do is we will have the audited values. We'll come up with what is the ratio to the book value of those items. So now we will have to look up the book value of all those different items to find out what the reported book value was of those. And when we do that calculation here, it comes out, guys, to roughly about 95%, 0.95. So this is telling you, okay, the audited value to the book values are about proportionate. Okay, they're pretty close. So I can go ahead and I can use the ratio estimation. So I multiply that by the 4.5 million. I'm just showing you that's 95%. And that gives me what? That gives me my point estimate here for 4,275,244. Now, where this example falls down a little bit, guys, is they start using difference estimation, even though the book value to the audited values are proportionate. And so what they do here is they go ahead and they say, well, the difference here between the 175 and the 184, and I think that ends up coming out to be about 9,200. Okay, so you have 9,200 difference there divided by the 200 items times 5,000 gives you a projected error. And then you go ahead and since the audited values were less than the book value, you subtract that from what the client had been reporting. You take that projected error and you subtract that from what the client was reporting. And that's how you come up with this point estimate. Now, difference estimation. Another way to look at this, okay? The amount of error in the sample, okay, sample error is 920 here, 9,200, right? That's the error in the sample, right? The book value of the audited items was 184,200, the audit values, so there's 9,200 sample error. Now what happens? I went ahead and I'm going to set that equal to the population error. But I'm going to multiply that by, and look, if there were 5,000 items in the population, and I looked at what? 200, what percent of the population did I look at? 0.04, 4%, right? Okay, so I could go ahead and say, well, okay, population error is what? Since I looked at 4%, that should equal 9,200. And then I go ahead and I take the 9,200, just doing the algebra, divide both sides by 0.4, and I get the same answer. My projected error is 230,000 is another way to look at that. Okay. Now, I'm probably going to lose the camera for the rest of the night, guys, but I think it's okay for what I think is something that I want to do right now that I think is worthwhile. Okay, so the camera may crap out on me for the rest of the night. I don't know, but that's okay. You're probably tired of looking at me anyway. So let me go ahead and exit this. And I'm going to open up the software. Okay, and I want to find, and the question I want to find and write this down. I want to find multiple choice question 02. Guess they don't put the O in there anymore. 585. Okay, good. Okay, and when you look at this particular question, they say an auditor established a tolerable misstatement of 60,000 for an account balance with $1 million. Okay, the auditor selected a sample of every 20th item from the population that represented the asset account and discovered overstatements of 3,700 and understatements of 200. Under these circumstances, what would the auditor conclude? Okay, now when you look at this, you could set this up, and I guess I better go to my whiteboard here, and I'm just gonna put it right here. Well, maybe not, because I don't want to mess this up permanently. So can I give myself a new board? Okay, good. Can you see my whiteboard?
Yes.
Okay, so what happens? I look at this and I'm saying that the misstatement, and guys, if auditors are lucky enough that your misstatements move in different directions and they cancel each other out, I might have some internal control issues I'm worried about, but I might get lucky that it doesn't result in material misstatement if they're canceling each other out. So 3,700 overstatements, 200 understatements comes to a net misstatement of 3,500. Now, I could set that up so that I'm saying that the population error rate is going to be equal to that number times. And if I looked at what? Every 20th item, then I looked at 5%. That's what that question said. And so if I go ahead and I divide each side by 0.05, that means that I think that the population's error rate is, if I'm doing my math right, 70,000. With me so far? Which is, so what this question was doing was showing you ratio estimation, even though they didn't call it such. I mean, not ratio, but my bad, difference estimation, even though they didn't call it such. Okay, now what happens? If you look back at the question, they want us to draw a conclusion on this. Okay, and only the auditing exam, by the way, has analytical type multiple choice questions like this. Okay, they want to say, well, what conclusion do you draw from this? Well, do you think the account balance is fairly stated if you had a tolerable misstatement of 60 and I just projected a misstatement of 70?
No.
No. The asset account is fairly stated? No, I don't think it's fairly stated. There is an unacceptably high risk that the tolerable misstatement exceeds the sum of the actual overstatements and understatements, the net, not the sum, but the net of them. Okay, yeah, that is, or there's unacceptably high risk that the actual misstatement of the population exceed the tolerable misstatement because the total projected misstatement is more than the tolerable misstatement. Yeah, it's not the sum, it's the difference, right? I would take in the net. So the correct answer here is D. But you could get rid of A and B. They said the sum, but they net each other out. So that's why D was correct. That's why C was wrong. D was correct. Question? Okay, good. So the question number that explains, I think, gives you a little better look at how you would use difference estimation is 2585. 2585. 2585 is the number that for that question that you should be looking at for difference estimation. 2585 multiple choice question. Okay. Okay, good. Now I'm going to try to put us back in tablet mode. I will likely lose the camera. That's okay. So my camera is gone. Can you still hear me?
Yes.
Okay, so the camera, we'll just forget it for the rest of the night. We don't have much time left anyway. Okay, good. Now what happens? We go ahead and now coming back to the next page here, we then can form a conclusion as to whether or not we want to accept the client's balance, okay, by taking the point estimate and giving ourselves a precision, which is an allowance for sampling risk, okay? So we know that the recorded balance was what? Recorded balance was 4,500,000 from, I'm going to just extend this example that we were just looking at here. We know that the recorded balance was 4,500,000, right? Now, we came up with a point estimate and we used different methods, but if we were using mean per unit, okay, we're using mean per unit, then the point estimate would have been 4,375,000, guys.
Yes.
Okay, just looking back at that or remembering back to that example. Okay, now I'm making this up. Let's say my allowance for sampling risk, okay, the allowance for sampling risk here is 50,000. I'm making this up. The problem didn't give me this. I'm making this part up. Let's say it's 50,000. I just want to make the numbers easy. So plus 50,000 would bring this up to 4,425,000.
Yeah.
Okay, and the minus 50,000 would bring this down to 4,325,000. Now the recorded balance is 4,500,000, right? So let's say the auditor's tolerable misstatement equaled 100,000. In other words, I'm willing to take a misstatement of 100,000. And so I'm willing to go as high as what? As high as 4,600,000 and as low as what? Somebody help me out. 100,000. Well, I don't think I need help. 4,225,000. Okay, and the recorded balance is what? 4,500,000. So is this a happy auditor or a sad auditor?
Happy?
The auditor is happy because I'm sitting there saying, well, look, you know, I'm going to go as high as 4.6, they're at 4.5, so I don't think there's a tolerable misstatement. Okay, now let's say that my tolerable misstatement was 60,000.
Can I ask a question real quick?
Yeah.
Why would we subtract the tolerable misstatement from the lower allowance for the sampling risk instead of from the book value?
Because I believe the correct amount using mean per unit estimation was 4,375,000.
Oh, okay.
I mean, yeah, 4,375,000, and then I put myself an allowance for sampling risk.
So then you add or subtract the tolerable misstatement.
Right. I'm saying the correct balance is 4,375,000.
Okay.
My client's saying it's 4,500,000.
So
And I
what
want to
is
see,
the range?
and I want to see if I can live with what they're reporting.
Okay.
Yeah.
Yeah.
Okay, now if it was 60,000, I probably need another color in here, and this might be overkill with the colors, but if it was 60,000, now I do need help with the math. 4,375,000 onto 60,000 gives me what? 60,000 plus 4,375,000 gives me what?
4,435,000.
Okay. And if I subtract it from 4,375?
15.
Huh?
Wait,
4,375,000 minus 60,000. 4,315, you say?
Yeah,
Okay, so it'd be
that's
down.
what I got too.
Okay. So I don't know why I wrote 4,375,000 twice. Oh no, that's 325. So it's now 4 million, say it again, 15,
Yeah, 315.
315. Okay, now is the auditor happy or sad? I'm
Sad.
willing to go as high as this, but they're over here, aren't they? So
Mhm.
now the auditor is sad. The auditor is saying, hey, look, we need to do something. And at this point, you're probably going to expand your sample to get a handle on how much the misstatement is and start to ask for adjustment and that kind of stuff. Or if the client sits there and says, hey, you know, the hell with you, we're not going to make any adjustment, then we're going to do what? Let's say you want an adjustment to bring it down below your tolerable misstatement. You do enough audit work that you're convinced that there is a material misstatement, the client won't fix it. What are you going to do?
You would consider doing a adverse opinion or qualified opinion.
Qualified or adverse good, depending on the pervasiveness. Excellent. Okay. And then, of course, we'll document the procedure. Question.
Yeah. Can you kind of go back over how you got that 4,600,000 at the very top?
Say that again.
$4,600,000 in the black.
Yeah. The 4,600,000 in the black was the, now I'm having trouble remembering what I did, was as high as I was willing to go when I took the allowance for sampling. Oh, I see. Did I screw this up? Maybe I did. Okay. Because I would have taken, and maybe this is what you asked, Michael, and I messed it up. I took the point estimate, right? Of 4,375,000. And I should have added what? Let me start over here. 4,375,000. I see what I did wrong here. I added it to the 4,375,000, and I would have added, oh. Just a second, guys. Yeah. Good. I'm actually, this is good. This is happening because I want to discard this. Definitely discard it. Get rid of this junk. Let me start over again. What chapter are we in?
Chapter 3, page 89.
Okay. Okay, good. At least it brought me back to the same page. Let's start this over because I think I did mess this up. I got lost in a sea of numbers here, guys. I'm sorry. So let's just take a look. So using mean per unit on the previous page, we had what? We had a point estimate of 4,370,000, right? That was just using mean per unit. Okay. And then I said the allowance for sampling risk was what? 50,000. And the book said that the client balance was 450. Right? Is that about where we were? Okay.
Yes.
Now I take that 50,000, okay, and I add it to the point estimate using mean per unit. 50,000 plus 4,375,000 is how much?
4,425.
Four what?
25.
Well, it can't be less. Okay, 4,4. Yeah, okay, 4,425, right. Okay, good. And if I subtract the 50,000, it is
4,325.
4,325. Okay. Okay, so I should have taken it and added and subtracted it to the point estimate. I think I did it to the book value that's causing the confusion. Okay, good. Now we look and let's say the tolerable misstatement equals 100,000. That means that I'm willing to go on this account balance as high as what? 4,4.
4,6. 4475.
4475. Okay, and I'm willing to go as low as what? 4275, right? I mean, yeah, 4275. Just plus,
Yeah, that's correct.
yeah, say it again. Somebody say it for me.
4275.
4275, thank you. Okay, now, when I look, the client reported what? The client reported 450, and I'm willing to go as high as 475, so the auditor is happy, right? Because the client reported 450, I was willing to go as high as 475, so the auditor is okay with that. If the tolerable misstatement was only what? Was only 60,000. Okay. Then I've got to sit there and to the 475, somebody add 60,000 for me here.
Uh, 4435.
4435.
Yeah, 4,435,000.
Okay, so 4,435,000.
Yeah,
Okay, and on the bottom end,
4,315,000.
4,315,000. Okay, so now what? The client balance is 450,000, and I'm sitting there telling them I was really only willing to go as high as what? 4435. You need to make some kind of adjustment to what? To bring that down to be within my tolerable misstatement. And again, if they refuse to do that and so on, then we would go from there. Okay. Sorry, I think I screwed it up the first time by adding my allowance for sampling risk to the book value, which I think was your question, Michael, versus the point estimate. Okay. All right. And then, of course, you document the procedure. Now, you come over, and another sampling plan we can use is PPS sampling. Now, what probability proportionate to size does is it sits here and it is going to pick as a sampling unit a dollar amount. Now, when it picks that dollar amount as the sampling unit, what's going to happen is we're going to select a dollar, but we're going to pull an entire transaction with that, and we'll audit that transaction, but we're really auditing that dollar. And so the more dollars that a transaction has contained in it, the more likely it is that that item will be selected, thus the term probability proportionate to size. And this is really the technique that is commonly used these days more than some of these variable sampling plans we've been talking about. So let's take a look at this, and let's just go through and this is where it would be nice to have the, if I could see everybody, but I can't. Guess I could do it this way. So let's say I go around the class here, and everyone in the class represents my client's customer. And everyone has dollars sitting in front of them. And those dollars sitting in front of you represent money that you owe to my client. Okay, now my client has an account receivable balance, let's say, of $50,000. So there's $50,000 bills sitting in front of everybody's desk here, okay? And that represents money that you owe to my client, okay? So let's say, and folks are gonna have to remember their number here, okay? So let's say we have the situation. Kaori, let's say you have $100 sitting in front of you, and you got to remember your number, $100 sitting in front of you. Okay.
Okay.
Now, I'm going to look and I'm going to say, Matthew, let's say you have $2,000 sitting in front of you.
Okay.
So remember that. Eric, you're going to have $4,000 sitting in front of you. And we'll finish with Michael. You'll have $10,000 sitting in front of you.
Okay.
Okay. All right, good. Now, I'm going to have a sampling interval and say my sampling interval is every $5,000. Okay. So I'll start with Kaori. How many dollars did you have sitting in front of you?
I have 100.
100. So you don't have my $5,000, do you?
No.
Okay, so I'm going to keep going. Who is next? Who is my next person?
It may have been me. I can't tell if somebody's in front of me.
Who's that?
Eric, it may have been me.
I don't think so. You were more towards the end, I think. Okay, go ahead, Eric. How much did you have in front of you?
4,000?
4,000. Okay, do you have my $5,000?
Nope.
Okay, good. Who's next?
I had 10,000.
I don't want you yet, Michael.
Okay.
There was a reason I went in the order I went in, which is kind of being screwed up here. Matthew?
Yeah, I think I had 2,000.
2,000 sitting in front of you. Okay, good. Okay, now I thought Matthew came before Eric, and because I want to design this a certain way, I want to engineer this a certain way. So Kaori didn't have my 5,000. Michael, did you have my $5,000?
Yeah, I would.
I mean, not Michael. Matthew,
I would.
would you have
In
my
this scenario?
$5,000?
I would.
How? I'm looking for the $5,000. So far, I've got 100 from Kaori and I got 2,000 from you.
Sorry, I got confused. I would not. Since I was
So you-
in second. Yeah.
Right, so you would not. Then Eric, we bring you in at 4,000. Do you have my $5,000?
Yes.
Somewhere along the line of going through your dollars, I hit that 5,000. So what happened? If this was, say, accounts receivable, I'll send out a confirmation to Eric, right? And then Michael, you were 10,000?
Yes.
Because now I'm looking for what? Now I'm looking for my $10,000, right? And so what happens? Michael has my $10,000. He almost, if I should have engineered it a little better, let's say he had 12,000. Okay, let's change up that a little bit. Let's say he had 12,000. Not only would Michael have what? My $10,000, and we know he has to have one of mine because I have a sampling interval of 5,000, but he actually has what? Both my $10,000 and my what? And my $15,000. Okay, because if you add what? 1 + 2 + 6 plus he's got 12, he's got what? He's got my $15,000 too, doesn't he?
Yeah.
Okay, so what happens? I actually will get to test $2 here, 2 sample items, because my sample item is $1 by sending out what? 1 confirmation. And notice that I also got the big one that Eric had, because the more likely probability proportionate to size, the more dollars in there, the more likely it is that the item will be selected. And of course, I engineered it a little bit, but that is the idea behind PPS. So now when you look at advantages of PPS, it automatically emphasizes larger amounts. So it automatically does what? Automatically stratifies the sample. Okay. Also, if no errors are expected, then PPS can give us smaller sample sizes. Because again, look what happened with Michael's. I only have to send out one confirmation. I'm getting to what? Confirm $2 in my account balance. Okay. Disadvantage of PPS is what? If you have 0 or negative balances, those items will not be selected because you have to have at least $1 in front of you as I'm trying to accumulate to get the dollars. That's a disadvantage, but I can design around that very, very easily. What I would do is if I had some zeros, I would take those zeros out, right? And do something separate with those zeros. Maybe pull a sample of the zeros, or maybe I'll go ahead and confirm every single zero that's on there. I'm not so worried about that because what? For accounts receivable, I'm worried about the existence assertion. And so I'm not really worried that it's going to be what? That it should have been more than 0. I'm worried if they reported too much, right, for the existence assertion. So I might do something with those zeros, but they're not giving me a lot of heartburn. And I'm here to tell you that if there are negative receivables, I'm absolutely going to want to find out what's going on with those, because if they are truly negative, what does that mean? If you have something listed as account receivable and it shows a negative balance and that's correct, what does that mean?
Someone overpaid and we owe them.
That's a liability. That needs to be put in the liability section, doesn't it? When you have to sacrifice cash to somebody, FASB's defined that as a liability. Okay. Okay, good. Now we come over, we've got the advantages, disadvantages, and then we're going to go ahead and play with some numbers here. But it is worthwhile in the example, but it is worthwhile to go ahead and flashcard how you calculate that sampling interval that we were just sort of messing around with, which is your tolerable misstatement divided by something called a reliability factor, will give you a sampling interval, and then your sample size will be whatever that sampling interval is that you just calculated above, divided into the recorded dollar amount of the population. Now, let's go ahead and use a numeric example. Okay, and here they are saying that we have a tolerable misstatement of 15,000. The risk of incorrect acceptance is 5%. Risk of incorrect acceptance means I'm willing to accept a 5% chance that I will accept a materially misstated balance, right? Okay, so I'm taking on some risk here. And then the recorded amount of the population is 500,000. Now, you come over and for the 5% risk of incorrect acceptance, some genius, okay, we don't have to calculate reliability factors, said that the reliability factor associated with that is 3. So if you take the tolerable misstatement of 15,000 and you divide that per that little formula we saw a minute ago, reliability factor, that gives you sampling interval of 5,000. The recorded dollar population was what? Was 500,000. $5,000 divided by 500 divided into 500,000 means that I'm going to look at what? 100 sample items here. Now, just to see how this reliability factor works, okay? If I want a risk of incorrect acceptance of 1%, do you think I'm going to need a larger sample size or a smaller sample size?
Larger.
Good. I need larger because I'm trying to lower that risk, right? Excellent. So now they give me a reliability factor of what? 4.6. So I take the 15,000. I divide it by what? 4.6. And that reliability factor now tells me that my sampling interval should be what? 3,261, give or take. Okay. And so what happens when I divide that by the into the population value, now I get 3,261. 3261, I get a sample size of about 153. Did my sample size go up? Sample size went up because I wanted to reduce my risk. Okay. Okay, good. Now we've said this a number of times now, and we have a random start. Okay, so we can't just say, well, you know, it's 5,000th item, because that would not be random. So we go to our random number generator and it tells us your random start is 300. My sampling interval for the fact pattern above is 5,000. So I'm going to look for what? I'm going to look for the $300 with my random start, the 5,300. Now I'm on my interval, the 10,300, and so on. Okay. So I come up to this first one and there's $150 in there. Does that account have my $300?
No.
No. So I keep going. I add in the next person at 800. That brings me up to 950. Now that person somewhere in the middle of their dollars, I hit my what? $300. So I go ahead and I select them. Now I'm on my interval. So now I look for what? 5,300. So I go to the next person. I add them in at 1,400. We're up to 2,350. Do they have my 5,300?
No.
But I add in that next one, number 4 here. Now the total goes up to 6,700. So somewhere in the middle of their dollars, they have the 5,300, right? So I send out a confirmation to them. Now I'm looking for the 10,300. So I go ahead and I add in that next one, got me up to 9,000, close, but not 10,300. I added the next one, 13,900 is the total. Yeah, somewhere in there, they had my 10,300 to send a confirmation to them. Now, this is where this gets interesting. So if you were floating off, come back to me, because what happens? Now we add in this 8,500 item. Now, I know this one's going to be selected because it's bigger than the interval. Any item that is equal to or bigger than the interval got to be selected, right? So I add in the 8 and it comes up to 22,400. So this one had what? This one had, and I was looking for my 15,500, but it also had my what? $20,300 in there, didn't it? So when I send out this confirmation, I'm actually doing what? I'm actually testing $2 here instead of just one, and so on. And I'm not going to go through the whole table. You'll go into a coma, but you get the notion as to how we would do this. Okay. Now, as I'm describing this, you think to yourself, well, holy Toledo. I mean, I'd be here my whole life if I was sitting here with a calculator trying to do this. Well, you know, you have software now that would go through and you would put in the parameters. What is your risk of incorrect acceptance, your materiality levels and whatnot. You stick all that in there, and then it goes through the client system and selects out the transactions for you. It's off software like IDEA or something. Okay, but that's the logic behind it. Okay, now you come over and now we're going to evaluate the sample results. So when we evaluate the sample results, we go ahead and we send out the confirmation, and it comes back that it's not 800, it's 600. So apparently there was a payment that got missed or something. So there's a $200 error in there. The recorded amount is 800. So we have what? We have what they call a 25% tainting. We multiply that tainting by the interval, and that becomes our projected error for that interval. Then we go ahead and we send the next one. There's no error. If there's no error, there's no projected error. No tainting, no projected error. Now we send the next one and the person comes back, and sometimes when you read confirmations, they're kind of funny because people will say all kinds of nasty things if it's wrong. I paid that, whatever, okay? And so what happens? We have 100% error here, and so we are saying that entire interval is in error. Now, very important. The next one was bigger than the interval. And we do find an error there. When that's the case, you bring that error directly over to your projected error. You do not do the tainting exercise. Now, don't write this down, but sometimes I'll get students, well, why not? Okay, well, let's try it. Let's do the tainting procedure and see what kind of weird results. The error was 1,600. The recorded balance was 8,500. So we have a projected error there of something like 18.8%. If you take that 18.8% and you multiply it times the interval, you would get a projected error there of something like $941, which is a nonsensical response because we know the error is what? 1,600. Why would we project an error that's less than what we know the error to be? So you don't apply the tainting procedure if the item that you're looking at is bigger than your interval. Okay. Then finally, we wrap up this procedure and we find a $300 error in this next one, and we divide that by 1,500. That's a 20% error. We apply that to the interval. We project 1,000. You add everything up, and the total is 8,850. Is the auditor willing to accept the account balance at this point? What was my tolerable misstatement?
5,000.
Try again.
15,000.
15,000. Good. So my tolerable misstatement going way back up was 15,000, wasn't it? Wherever the hell that went down.
You just
15,000, and where I'm down here. So, okay, I'm kind of happy with this, that you didn't see my tolerable misstatement, but I got to tell you guys, I don't like this $1,600 error. I don't like this $4,900 error. So I might start asking questions about the internal control. I might want to pull another sample to see what the heck's going on here. So there are what? There's not just quantitative aspects, but there are also what? Qualitative aspects that I would start to consider. What is the cause of the deviation? Was it intentional, unintentional? I don't like that $4,900 one. Okay, good. Now you come over, and I'm just bringing in the, professional skepticism here. Now, the size of the sample designed for dual purpose testing, meaning that when I pull the transactions, I can do both the substantive procedure and the testing for the operating effectiveness on the same transaction. The sample size that I will use is the larger of what is needed for either the control test or the substantive test. And you can flashcard that. Okay, good. In the little bit of time we have left, guys, let's go ahead and let's take a look at some multiple choice questions, and we'll adjourn for the evening. Okay, guys, we're coming up on 2 minutes and I want to go ahead and end the poll here because we are getting kind of short on time. So let's look at this one. And good work. I think most of us saw the analogy between this question and what we just exercised with. And so let's go ahead though, and let's look at this one together. And they tell me that I have a sampling interval of 10,000. Okay, so I know I'm going to use that in the calculation of my projected error. Now they tell me that the recorded amount was 5,000 and the audited amount was what? 4,000. So we have what? $1,000 error here. Okay, and since the recorded amount was what? 5,000, we've got a 20% tainting. We multiply that what times the interval, and that gives me projected error 2,000. The answer to this question, okay, which most of you got in pretty good time. Okay. All right, good. Let's take a look at question 2. There's no question on that one. Okay, it looks like everyone has had a chance to try this one. We're at about a minute 15 mark, which is great because it looks like everybody got this, just about everybody got this right. One person wanted A, and I think maybe, you know, when we start to get late here, we just got done looking at PPS. Maybe you wanted to pick PPS because you said, well, we were just talking about it, so that must be the right answer, okay? PPS automatically stratifies the sample. So the auditor wouldn't have to manually stratify the sample the way I was talking about in that example stratification where I picked those top 5. Remember that example? Okay. Where we would want to stratify, manually stratify, is we have the population has highly variable recorded amounts. We had those big ones at the top, and then we had a bunch of little ones clustered together. Well, that would be considered highly variable amounts. And so we would go ahead and stratify under those conditions. Okay, PPS automatically stratifies a sample because probability proportionate to size, right? And we saw that in the example. Okay, good. Let's go ahead and let's do the last question of the evening. Okay, guys, we're coming up on 2 minutes and we're getting late here, so I want to go ahead and end the poll. And we did pretty good on this one. 86% of us got this right. You know, I mean, we have material misstatement, whether caused by error or fraud, okay? But if the entity is sitting there and concealing things from us, then that is that's getting into risk factors that go beyond the sampling risk and everything else that we've been talking about. So if something is trying to be concealed, then you start saying, well, how slick are these people? What are they trying to do to me here? That would have broader implications, although I agree that C might be of concern, because if they misunderstood the instructions, maybe that control does not quite have the operating effectiveness that I would like it to have, and that could have some broader implications. But D is clearly, if they're forging things, now they're hiding stuff from me, now they're making my job nearly impossible, right? The only deviation discovered in the sample, which I think one person picked, that would probably give me less concern as to the implications, because it's, nobody's perfect. It's a one-time thing. Okay, question. Okay, guys.
Question, Professor, in the general, in the actual practice, since you're doing a sample, like granting the client really did the perfect accounting, and in fact, they are correct. It's not materially misstated, but since you use sampling and now you have a risk of negative rejection, and if they will not do the adjustment and you will disclaim, does that happen, or how do you address that? If
Okay, I didn't quite follow all that. I find a material misstatement. Is that what you're saying?
yes, based on my sampling, but
And they won't adjust it?
yeah, because to their recording, it's to their belief, and they are actually, there is no actually material misstatement, but because of your sampling, of course, there's error, right?
Well,
So how do you handle that?
well, wait a minute now. If you're telling me that I had incorrect rejection, that is what you're saying.
Yes.
Then what's likely to happen, I pull a sample and the sample indicates it's a material misstatement, right? Well, I'm not going to barge into, the CFO's office and say, we have a material misstatement, fix this, right? I'm going to say, that is of concern. I've got looks like a material misstatement. Let me pull some more items and sample those further. Or let me do some additional procedures that will allow me to get a handle as to how bad this problem is. And the conventional wisdom is that through that process, I should discover that there indeed was not a material misstatement. I mean, the theory is that auditors shouldn't be going around slapping people around for misstatements that aren't there. So I guess if I'm inept, and the client's going to say, well, I'm not going to make an adjustment. This auditor is incorrect. And they may, at that point, suspend the engagement and say, we're just going to get somebody else in here. I think that's, even though the risk of incorrect rejection is something that is talked about in textbooks, the notion that that's going to really occur is highly unlikely.
Yeah, so you can do furthermore testing. Okay.
That's why they say you're not efficient, and that you'll probably come to the right answer, but not in a very efficient manner if you had to start expanding the sample size and whatnot to find that indeed there was not a misstatement.
Got it. Thank you.
Yeah. Okay, guys, good work. Yeah, we're behind, I know. I'd rather be thorough than fast at this point. So chapter 3, if you really look back, a lot of important concepts for us. Please get your homework done for chapter 3 this week. so that we can sort of, now that we've figured out all the assessment of risk and how we're going to sample transactions, now in chapter 4, we can start seeing how we'll apply procedures to account balances, and be able to allow us to determine if there's material misstatement in the financial statement assertions embedded in those account balances. Okay. All right, guys. Oh, and we still have the data analytics module, but we'll do that next time. I don't know why Becker puts together chapters that contain 110 pages, but we'll get through it. Okay. All right, guys. I will see you next week. Do your homework.
Thank
Chapter
you. Have a good night.
3, everything but module 10, right? Okay, guys. See you next time.
Thank you. Have a good
Thank
weekend.
you.
You too.
Thank you. Bye.
Good night.